Tesla stock has been in absolute free fall since the beginning of the year, and some investors have been urging the company to use its vast amount of cash on its balance sheet to step in and do a share buyback. Now, many companies have been buying back shares of their own stocks only to see their stock prices continue to head lower, thus essentially throwing away cash. For example, Facebook's parent company Meta spent $48 billion to buy back just 6% of their shares at an average price of $304 per share. But since then, the stock has fallen to around $100 per share. So that same amount of cash could now take out 20% of the company's outstanding shares, meaning they overpaid by about $32 billion based on the current share price. Now, Tesla doesn't have as much cash lying around as Meta does, and so it's important to tread cautiously when making these financial decisions to try and return money to shareholders. We've seen that the largest tech companies currently have far more cash than Tesla, despite Tesla being a larger company by market cap. Tesla is in the top 5 largest companies in the US, but doesn't even make this list of top 13 cash hoarders in the country. While market cap isn't everything, Tesla is actually in a very cash-intensive industry, building large physical objects that require plenty of raw materials, while most other large tech stocks rely mainly on software for their revenue and don't need to build massive factories in order to run their businesses. Even a company like Apple, for instance, outsources the manufacturing of its hardware products. Nonetheless, on the most recent conference call, Elon Musk said that the company was considering a $5 to $10 billion buyback, adding that some meaningful buybacks were likely, as the company takes into consideration what its shareholders are saying about the plummeting stock price. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Now, Tesla has actually been an extremely well-run company from a financial perspective. Just a few years ago, the company was indeed burning through its cash at an extreme pace. Critics from every corner didn't think that Tesla would make it past 2018, and later on, Elon Musk did admit that the company was weeks away from bankruptcy during the Model 3 ramp-up, but Tesla was able to execute and pull through these extremely difficult times. However, a few years later, Tesla actually raised cash by issuing shares, and interestingly, it did this 3 times in 2020. This was actually a time when arguably Tesla didn't need the cash. Besides a few one-time quarters, they were actually cash flow positive and thus organically increasing their financial health quarter after quarter. However, Tesla listened to investors and critics who urged the company to raise cash and bolster its balance sheet, even though the cash has been sitting there until today. Tesla issued new shares in order to make this happen, effectively diluting shareholders in exchange for cash. To make this clear, they sold shares into the market, which is the exact opposite of a share buyback. At the beginning of 2020, Tesla had $6.3 billion of cash, but also about $10 billion in debt. In February 2020, they raised $2.3 billion at the equivalent of $50 per share relative to today's split-adjusted price. Tesla just closed yesterday at a 52-week low of $177 per share, so they sold shares about 3 times lower than the current price. Then in September, they did another offering and raised $5 billion at about $140 per share. And then for a third time in December in 2020, they raised yet another $5 billion at $179 per share, which happens to be actually slightly higher than yesterday's closing price. So if Tesla is going to do a share repurchase, at this low level it actually works out quite well that the current price is slightly below what they sold shares at a few years ago. While their initial sales in 2020 were far lower than the current price, meaning that they sold low and would now buy high which is the opposite of what you want to do, the third issuance in December of $5 billion would be about break even compared to today's stock price, making a strong case for essentially taking back those shares now that the balance sheet is much stronger. Today, Tesla is throwing off cash like crazy. They have over $21 billion of cash on their balance sheet, up over $2 billion from just the previous quarter thanks to their operations, which is pretty amazing considering that just a few years ago it cost them money to raise that much cash. And the cash that they raised in the past is still technically part of this cash hoard since they never deployed that money on anything. In addition to this, they've also paid off the majority of their debt, with just $2 billion of long-term debt and finance leases remaining on their balance sheet. Now, one suggestion that has been going around online is that Tesla should issue new debt in order to buy back shares. While Tesla's credit rating has improved, interest rates have also increased, making this less favorable. Theoretically, adding debt to a company increases the enterprise value of the company, but Elon Musk and CFO Zach Kirkhorn are running Tesla more like how a prudent person would manage their personal finances. Imagine paying off your mortgage, and then as a reward, you get another mortgage. That would be similar to Tesla finally paying off basically all of their debt, and then having to issue more debt to buy shares. If anything, they keep adding so much cash each quarter that it makes more sense to at least use that cash, which will quickly replenish, than adding back more interest-based debt. Another thing is that it's not guaranteed where Tesla stock is headed. The idea of a buyback was brought to the attention of the company months ago when Tesla stock was much higher, in the mid-$200 range. Doing a share buyback at that price, even just a month ago, would seem a little dumb, at least in the short term by management, with shares having fallen significantly to the current price of $177. And so being opportunistic, if possible, makes more sense than buying shares at any price. In the past, Berkshire Hathaway CEO Warren Buffett, for instance, was very disciplined on only doing share buybacks when the share price of his company dropped below 1.2 times book value. He since modified this metric, and this wouldn't apply to Tesla, given that their book value is significantly lower than their market cap, but buying shares at any price for the sake of buying shares is probably not the best idea. It seemed like on the conference call the Tesla management team would take their time to think through how they would execute a share buyback in a disciplined way. That said, Elon Musk believes Tesla is on the path to become a $4.4 trillion company, yet it's important to maintain a robust balance sheet in order to increase the probability of getting to that level. Now today, Tesla resides at $590 billion in market cap, even after this huge sell-off. In recent days, Elon Musk has been selling shares of Tesla in order to help fund the remainder of his Twitter acquisition to the tune of $4 billion. Now, Twitter is a bit of a short-term distraction, which has created some opportunity, but it's likely that Tesla may not be nimble enough to buy shares exactly at these depressed prices. It's also not clear how much of an impact buying shares would have. If Tesla buys $5 billion worth of stock, that's a bit less than 1% of Tesla's outstanding shares. It's unlikely that investors will factor that into their future valuations. Furthermore, when Elon Musk sold $4 billion of Tesla in the last few days to buy Twitter, he's selling them in the open market. These are shares that otherwise weren't being traded since Elon Musk was sitting on them and not selling. Now that they're being traded in the open market, it in a sense adds more supply that otherwise wouldn't have been there. So using Tesla's cash to buy back $5 billion worth of stock could help counter this effect. What's interesting is that usually during good times, companies have extra money that they think they don't need, which is why it appears to be very common to be buying back shares at much higher prices. When times are bad, the share prices come down, but the cash may actually be more useful in order to support the company or to invest in a better future, which makes it difficult to buy shares after a plunge like we've seen. Tesla's in a unique position where they're bringing in loads of cash and their shares are down drastically, over 55% year to date. But at the same time, timing the market is very difficult, and Tesla isn't in the business of trading stocks. Even the CFO has better things to do, such as managing the rollout of Tesla's insurance product, for instance, which will truly add greater long-term value to the company. So do you think it now makes sense for Tesla to begin returning cash to shareholders in the form of buybacks, despite issuing shares at much lower prices in the past, while the money wasn't really used for anything? Or is it more important for Tesla to use its cash to continue beefing up its war chest for an uncertain future? Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.